Okay, so I think that we're probably about ready to go ahead and get started here. So first, I just want to say thank you to everybody for joining us today for another Apriem virtual event. Also, thank you to those of you who attended our last virtual event on understanding life insurance basics. For those of you that attend often, you're probably aware that we normally do these the last Wednesday of every month. But here we are, middle of October. It's not the last Wednesday of the month, and we pulled this presentation together because of all the current market volatility that we're seeing. We thought that now was a good time to really talk to all of you, and we want to be able to address all of your questions. So as part of this process, I think a lot of you probably saw the survey that went out. We got a number of fantastic responses back, and we're going to try to address all those questions that we received. We have an hour set aside for today. However, we might run a little bit long, just depending on how things go. You do have the ability to submit some questions. So in your Zoom software at the bottom, there's a Q&A tool or feature that you can use to submit questions along the way. Depending upon how time goes, we'll try to address those towards the end as well. With that, I'd like to go ahead and get us going and introduce our guest speakers. So today, we actually have the entire Apriem Investment Committee with us, starting with Benjamin Lau. Benjamin is the Chief Investment Officer here. He's been with Apriem for 2 decades?
Yeah.
Or in the industry for 2 decades.
Stop counting.
Ben has been quoted by a number of top financial publications, the Wall Street Journal, CNBC, Bloomberg, sharing his views about stocks, bonds, interest rates, behavioral finance, and really just talking through different investment trends. And then at his side, we have the investment committee. And on the investment committee, starting with Jose Rendon, our senior portfolio administrator. And then next to Jose, we have Andrew, who is also a portfolio administrator. And then Kenneth Mullen, who is a portfolio administrator as well. So thank you guys all for joining us. Ben, as we kind of jump in, do you want to kind of give us an idea of, maybe bring us up to speed, what's going on with the market and what's Apriem been doing?
Awesome. Thanks, Josh. First of all, I'm really happy to do this today with you, with everyone here. I'm really humbled the fact that so many people have decided to join us for this webinar here. I know it's pretty unprecedented times. Again, I do want to repeat, because we're doing this through a webinar, try to submit some questions. And we have allocated a good amount of time to answer your questions. But this is a large broadcast. We're expected to have quite a few people in here. And so we're going to try to answer as many questions as we can, as broadly as we can. We do have numerous strategies that some of you might be in. So some of these questions might not apply to you. And so if we have any specific questions, if we can't answer any specific stock questions or account related questions, but if you have any questions, we'll try to answer your questions offline, maybe give you a call or shoot you an email, or obviously contact your wealth manager if you have any direct questions about your situation here. So let's take a quick recap of what's been going on. What a year, right? So far, the markets have been pretty volatile. We've seen a lot of volatility, a lot of really downward movement in bond prices and in the stock market. It's just a lot of craziness after a relatively smooth 2 years since COVID. The market has kind of reversed course here. And it's our contention that a lot of the issues that we're going through today is really based on inflation. And that's really the biggest factor that's affecting the markets right now. And that's what's causing a lot of pain right now. And as you see on the chart right here, we have a chart of one of the most commonly used measures of inflation, the CPI index, or the consumer price index, right? This measures everything from gasoline to housing to food cost. And you can see here, since the COVID lows, it's spiked up here. We're now sitting at over 8% on the CPI right now. And that's a dramatic change. This is a dramatic change, and we haven't seen this kind of inflation for decades, right? And so for many years, we're sitting around 2% inflation, and 8% is a huge change. And I really think that's the major issue, right? With all the stimulus that the government has put out there from Congress and the White House, under all the stimulus from the Fed and low interest rates and what we call ZIRP, or zero interest rate policy, that's really caused a lot of price pressure right now. We've seen a lot, and that now that's going to have some side effects, right? And we could argue about what the Fed should or shouldn't have done, but I clearly think that the Fed probably should have raised interest rates earlier, and Congress probably should have cut back on the stimulus earlier, but they didn't. And they waited, really, the Fed waited until this year to start raising interest rates. And now that the Fed waited, I think they were kind of behind the 8 ball right now. And I think that's really causing them to really be a lot more aggressive on raising interest rates than they initially had hoped. And so on this chart here is the Fed funds futures, right? This is the short-term interest rates that the Fed controls. And so this run, you see here that the Fed funds have been low for years now, really post the great financial crisis. It came up a little bit, but it's been flat since COVID. And look at that. Went from about 25 basis points all the way to 3.25, right? That's almost a 3% increase, or a 300 basis point move in short-term interest rates. And that's a dramatic move. I think that dramatic, it's not really going to pivot, right? Everyone talks about the Powell pivot. This is a Powell 180-degree turn on interest rate policy. And that 180-degree turn is really what's, I think, the genesis of what we're seeing in almost all asset classes right now.
Actually looks like a U-turn on there.
It does look like it, right? And so this is Fed funds, right? This is what the Fed controls, short-term interest rates that really affects your checking accounts, savings accounts, but more than that, right? Because almost everything in terms of borrowing is based on this Fed funds. So this really translates into anything you're going to pay for an auto loan, credit card interest rates, right? And most importantly, for many Americans, their mortgage rates, right? You're really seeing mortgage rates really rise along the lines of what the Fed has done. And so, but with the sudden dramatic rise in Fed funds, I think really this is what we're left with. Right? This is the chart of the S&P 500 over the last 3 years. You can see here that we had on the left side the COVID lows of about in 2020, and what we've done since post-COVID, this huge rally right at the end of 2021, and then decline we saw really this year. And the peak of the S&P 500, large U.S. stocks, was really at the end of 2021, and since then we're down. We're down about 25%, give or take, from those highs. So that's been a painful move.
Yeah.
You're also seeing some similar losses, not just in large U.S. stocks, but across the board. Right? Technology, small U.S. stocks, small caps down by 31%, almost down by a third. NASDAQ stocks are down by over 36%. They're getting hard. And these are some of the large technology companies that we thought were quite safe and the bread and butter of the U.S. economy. But it's not just those. We look at speculative tech names, right? The speculative tech names that we've seen in the past, some of these like exercise companies or companies that even provide telecommunicating software like this one we're using right now, like Zoom. Speculative tech, they're down even more than the NASDAQ. They're down 50, 60, 70, 80% in many cases. And so that's been a huge carnage that we're seeing in the market right now. So
I think bringing this to talk about the survey that went out, right? We think about all those questions that we got. I think one of the big questions on everyone's mind is when's this going to end? When's the bleeding going to stop?
Yeah, this is one of the more popular questions we thought, right? We're down 25%, and it's continuing to go down, right? And we're still down even in the past weeks. The market still continues to go down and look for a bottom, and it's hard to tell when the bottom is, Josh. And that's the tough part about our job. When we look at the past, the market can go down a little bit more. The market has gone down depending on how bad a recession we go through, how bad the economy gets, right? But right now, the market is pricing a lot of bad economic data. I think a lot of bad economic data, bad earnings data has been front loaded into what we're seeing in the markets right now. But it's hard to tell whether or not it's going to end, right? Mm-hmm. But let me tell you, Josh, what we're looking for to see when it'll end. Right? Okay. And I'll contend that the issue that we're facing right now, as I said, is purely, not purely, but the large factor is inflation, right? Inflation is kind of what got us here. And then I think that's what we're going to look at to see what the Fed's going to do next in terms of what their interest rate policy is. One big component of inflation, and the rising cost of everything we pay. We feel it, when we fill up our gas tanks and go to the grocery store, is commodities, right? I don't need to belabor this point. We talked about this a lot. Commodities have seen a dramatic rise. And anything from on this chart, this is a graph of various commodity prices over the last year. Talk about, I don't need oil and gas, right? Most of us, Josh and I still drive regular gasoline cars. We've seen those prices go up and down, and now actually come back up, right? Gasoline, if many of you know, is actually starting to come back up in price after coming through some lows in the summertime. Mm-hmm. But what about food costs, right? Wheat, right? The situation in Ukraine and Russia, corn prices, how is that being affected? And you see here that the huge spike up in these raw material costs at the beginning of the year, all the way to the middle of the year. Some of it is due to obviously the situation we're seeing in Europe, but then prices have started to come down in the second half of the year, and we're going to be watching that as an input cost to inflation. Is our commodity prices relatively stable, and how are they doing? That's one of the big ones that we're looking at. What happens with OPEC, right? What happens with some of these cuts that they're trying to do, and how does it affect how much money we spend on everything that we need? The other factor is actually quite important too, is really the unemployment market, right? We look at that and see how healthy is a typical American family? Are they working, right? And right now we've been very grateful and thankful that America has had a very strong labor market here. And so what we did do is we graphed out two things here on this chart here. On the white line is the unemployment rate. I think the rate that gets most commonly quoted in the newspaper, right? The unemployment rate, or people that are unemployed, is sitting around 3.5% right now. That's spiked up to over 10%, 13% during COVID, and it's come back down dramatically due to all the stimulus we're talking about. And so from this point of view, the Fed and Congress did do what they wanted, where they brought down unemployment to a historically low level, and that kind of did their job. But what's next, right? And so the other graph we charted out is the blue line here. This is something that we're looking at a lot more frequently. It gives us a little bit more clear data. The blue line is something called the job openings, or JOLTS data, right? How many, when employers have an open application for a job, they had, a few months ago, they had about 12 million open applications for jobs. Now that's down about 1.5 million to about $10.5 million, 10.5 million people, or 10.5 million openings. And that's come down quite a bit. And so maybe if the job openings ease up a little bit, the job market is still healthy. If that eases up a little bit, hopefully that'll maybe soften up the pricing pressures that we've seen, or the wage pressures we've seen for a lot of employers right now.
I think this is a really interesting topic. So first off, let me just ask, because when we look at this chart, we can go, okay, we're right about where unemployment was, pre-pandemic, right, which is still low, but historically, is 3.5% unemployment low or normal? I mean, where would you put that as far as where unemployment tends to be at?
Yeah, I mean, I think this is a tougher one, right? Because we talk about history, we talk about the natural state of unemployment. I think this is what a lot of economists talk about. And for much of history, the natural state of unemployment is generally higher than we think that full employment should have been around 5%, 4%, 5% on the range. But the economy is a lot different now. It's really changed with so many self-employed people working, and so many entrepreneurs out there, the gig economy. So this is a very low unemployment by almost all historical standards. I think that's why you're seeing a lot of people make more money, right? You're seeing wage growth very, very strong, especially for the lower end of the demographic scale. Employers are having to pay up for a lot of workers right now.
And so just for the sake of the listeners, when Ben says natural rate of unemployment, right, being around 4 or 5% historically, right, that's because expecting zero unemployment is unlikely, right? There's always going to be some amount of turnover that's happening in the economy, but a 4 or 5%, that's a fairly normal rate environment to be in for unemployment. And to be sitting at 3.5%, I mean, is historically low levels.
Yeah. It's
just very, very interesting to see that.
And there's one actually. And one question we got from one of our clients is that this is related to, and this is an old economic theory called the Phillips curve, right? There is some relationship. There theoretically should be some relationship between unemployment and inflation. And the lower unemployment goes, lower than the natural level that Josh is talking about, inflation should start to rise. And we haven't really seen that up until recently. So that Phillips curve is really interesting to watch. I think explaining a lot of things we're doing right now.
So I do have to ask. So last week, Monday rolls around and the market's off to a booming start, right? I think Monday and Tuesday, the market ended up being up. The S&P 500 was up something like just shy of 6% in 2 days, I think 5.8%. And then we get to this jobs report. And the jobs report comes out and it's positive news, right? The news is that we've added 263,000 jobs. Expectation was 250,000 jobs. It was more than expected, right? So more people are working, and then the market drops. Yep. What's going on there? Like why is that happening?
That's right. That's happening because the economy, investors clearly feel like the economy is still quite strong. So strong that they now expect the Fed to probably continue to raise interest rates. And they're not seeing some weakness in the unemployment market that hopefully allows the Fed to back off a little bit. But the issue is that should you really wait for unemployment? How does unemployment really react to the stock market?
So as Ben alluded to, the unemployment rate is expected to increase as a result of the Fed's goal to bring down inflation. But although the unemployment rate is expected to rise, the market can rise too. The charts here show the last 3 recessions since the 2000s. The purple line is the unemployment rate, the S&P is the S&P 500, and the black line coming down is when the market bottomed during those periods. As you can see, the S&P performed quite well despite the increasing unemployment rate. In fact, the S&P performed well in similar scenarios dating back to the 1960s. The point here is that the market is an indicator of what is to come, not what is happening now. So a lot of what is expected is already priced in.
Yeah, and thank you. That's really an interesting case right here, right? We're seeing that the market fall before unemployment rises, and that actually has been historically the norm. Right? And unemployment is an extremely lagging indicator, and it's not a good indicator for what's happening right now, right? And so that's why it was interesting when we graphed it out, and we actually used JP Morgan for this. Yeah, it's surprising that the stock market and the green line and the unemployment rate, the purple line, it can diverge and not react the same way.
Yeah, I think it's really interesting because you look at it, you think about it, you go, okay, if the stock market's a leading economic indicator, it's already accounting for these things that are coming, right? And then unemployment numbers, technically that's a lagging indicator. People have already lost their jobs by the time we're getting this information that they are requesting these, unemployment benefits, and it's showing up in the unemployment number or figure, right? And so just sitting and waiting for unemployment numbers to start to tick up as being our sign, that something might change is maybe not an effective plan. Am I hearing you guys properly? Is that what we're saying?
That's what history is telling us. And again, I kind of want to emphasize what Andrew was talking about. Look what happened in the last great financial crisis. What I'm going to keep on calling it the GFC, right? The great financial crisis
Okay.
in 2007 and 2009, right? Unemployment continued to rise even after the recession was over. The unemployment can still continue to rise. There's more people getting laid off, and even after the market bottomed, even though unemployment was rising, the market bottomed and was rising. So the market rose while unemployment was rising. That's very counterintuitive, and that really goes to show, I think, how the market is a forward-looking indicator, trying to predict 6 months, a year in advance, and look ahead.
Okay, so I think that's fantastic information. I think that one of the things that we've all been talking about for a long time now has really been inflation. And I know it's been a concern, that's been on your mind most of the year, right? Has there been anything that's really happened over the course of this year that you would say, came out of left field and was a big surprise?
Oh, I mean, that's a great question, Josh. I mean, there's been a few things, right? When I think of the last 9 months, 12 months, we have been worried about inflation for a while, right? And I won't say it's a 12-month thing. We've been worried about inflation for almost the last 13 years or so, really since the GFC or the Great Financial Crisis. Right? That's really when we started printing, we entered a new monetary regime and started printing a lot of paper assets. We had the zero interest rate policy or reserve that we had, and that's when really things changed a lot. And that methodology, that mantra has been around for the last 12 years or so. And up until recently, all that printing of money, all that liquidity really hasn't translated to inflation, even though we've been worried about it for all this time, really hasn't translated to much inflation up until now. So what I'm surprised about, I'm not surprised that we had higher inflation, because I'm kind of expecting it. I'm really surprised at how dramatic it got out of control, right? And how quickly it rose from almost nothing to where it is today. And it's been, of course, about a year now where inflation has really gone out of control, but pretty much the middle of last year is when inflation started peaking. I do have to say that, we always talk about some of these things that we don't know that's going to happen. I think the big one was obviously the situation in Europe with Russia and Ukraine, right? That's been going on for a little over a year now. And although it was bad, it got worse, it was so surprising how much it got exacerbated, the crisis we saw in oil and natural gas prices, especially over in Europe, how much it impacted food costs and food pricing. So that was really, I think, the high inflation, the printing of money has kind of was kind of there as wood, but the starter, the catalyst to cause this fire was really, I think, the situation that we saw in Europe. So that was probably the biggest factor. I'm also a little bit surprised by how sensitive we are to global macro events, right? The U.S. has been relatively insulated from global macro events for a while now, outside of COVID. But look how sensitive things are, right? We had a relatively small economy in the UK, this small little island country across the pond. And when they changed administrations, when Liz Truss came in as prime minister, and that change, and that small change in tax policy and some of her economic goals led to dramatic shift, right? And it was a domino effect on on their treasury market, or what they call the gilts market. Their interest rates have shot through the roof. You're seeing some pension funds now have major issues in the UK right now. And how's that going to affect UK mortgages or UK real estate? And so small effects like in the UK, the market seems like it was very, very sensitive to those small little changes, and it's causing some major effects that are happening across the planet, and now they'll probably have ripple effects back here. So the macro events are really, really sensitive. Even Biden, even last week, right? Biden had changed the semiconductor policy, right? He's now restricting certain semiconductor sales to China, right? And so that's having an effect on some of our holdings in the semiconductor industry too.
So, I mean, as this data is coming down the pipe, we're seeing these things happen, and situation Russia, Ukraine, right? That occurs. These things happen along the way. I mean, how have we prepared portfolios for kind of the craziness of the markets? What's been done previously?
Yeah, this is a lot of this is about preparation, right? I don't know if it's the best thing to we use like the fire analogy, right? I don't know if it's the best time to prepare for a fire in your house when there's a fire in your house, right? You kind of want to prepare for the fire before the fire, have a good plan. Right? And so some of the things we've done along the way, and there's different levers that we can push and pull on here at Apriem to affect client portfolios. But historically, one of the biggest impacts you have to returns in client portfolio returns is, as simple as it sounds, the asset allocation, and how much stocks and bonds do you have in your portfolio? Do you have the right amount? And I know that all of our clients do meet with their advisors to come up with that strategy, but we've really been trying to do that allocation. And so for the past couple of years, some of our equity allocation, because of the great growth we've seen, some of the equities have grown to become overweight, and by default, some of the bonds have become underweight. And so for especially the bottom half of last year, the second half of last year, my team and I have been really careful about client allocations, right? We still maintain a slight overweight to equities, given our views on cash and bonds, but we didn't want to be too overweight. So we've really been dialing back expectations and allocations. And so we've been trimming that almost all year last year. I think that's been the right move. And we've got a lot of pressure from clients and just be more and more overweight equities. And I'm like, I don't know if that's, last year was a bright time to be super overweight equities. And I think you want to be more cautious and sell into these rallies and not buy more into the rallies. That's just from an asset allocation standpoint, right? From the stock side, and I know this is going to sound boring to you, Josh, but we have been quite boring, right? We continue to stick on the equity side with high quality businesses, durable companies that have great business plans and great models. They don't have a lot of competition, or the competition they have is not as good as them, and they're just different, right? They have a competitive advantage against their peers, and they're using that advantage really to generate strong cash flows, and that's really continues to be our mantra before this and after this too. And so we continue, and it sounds boring, but we continue to go for businesses that have strong cash flow, strong profits, and that really has allowed us to really invest kind of move on more boring businesses, but these businesses that are profitable, that are generating some positive economic returns, right? And so we have eschewed many of these non-profitable companies that haven't made money profit, companies that make these unicorns, these SPAC companies that we're talking about earlier, that just have a promise and a hope, and maybe some great cool technology, but really no product or no revenues, and definitely no profits. And so by skewing those, we've really been able to avoid a lot of the carnage in the equity market too. We can talk about some of the recent buys, especially in our larger strategies. Some of the recent purchases we made this year are quite boring, right? And so we bought a high quality business, almost a utility-like business, and a telecom provider that provides cell phone towers, right? We're always going to use more and more cell phones and wireless devices. So we thought that was a great business. Boring business, but very strong cash flow. It's not a theme of investing. We're not trying to play a theme, but we're trying to score for a strong business. Also, energy. We started picking away some energy. We bought some when energy prices came down, like you saw in the middle of the year. We started picking away. Go ahead. Some of these businesses, especially American businesses, are phenomenal. Right? There are some of these companies that were able to generate strong returns. If oil was at $100 a barrel, or oil was at $50 a barrel, and they can generate, because they have a strong moat, a strong business profile in terms of where they're pulling oil out of the ground, they can generate a great amount of cash flow. And so we thought those are great businesses to be investing in. So those are a couple of areas that we've kind of pivoted the portfolio in on the equity side.
I think one thing is I'm hearing that here, internally, and that I want to make sure it's really clear to everyone that's listening, is that as we're talking about these high quality businesses and the types of businesses that you buy, and we're talking about allocation in general, is that oftentimes we think stocks and we automatically think high risk, right? But within that category of stocks, you can have its own levels of risk, right?
Exactly.
I can have something that's maybe newer, smaller, right? Maybe they recently IPO'd or something along those lines, right? And that can bear more risk than maybe a company that's a lot larger, that's been around for a long time, right? And that those levels of risk, I mean, we're really looking early on to add companies that, even though they're not the newest names that, that you're hearing, when you listen to investment news, that's really, really exciting. They're maybe more boring names, but they're large, durable companies that have really helped that. We went through this recent period of time, right when we opened up, Ben talked about market being down, about 25%, right? But then we look at the small cap market, and small businesses, in general are down about 31, right? And then you're looking at just that really exciting tech space, which is down somewhere from, 35% to, maybe if we're looking at some of the more exciting, aggressive names, we could be down as far as, negative 70, 77, 80% on the year.
Yeah.
Right. And so even on the aggressive high risk side of the portfolio, you can still be buying things that are more conservative in an effort to prepare for something like this.
And great, I mean, like with the businesses we are buying, right, Josh, you're exactly right. They're not, we haven't been able to escape the losses, right? We're still, our portfolios are still down. But I think we've been able to save a lot of the card we saw in some of these unprofitable companies, right?
Right.
And the company has the profits, they're going to come out of this recession a lot stronger. And I don't know if some of these companies, some of these SPAC companies, some of these companies we're talking, these what I call speculative tech, I don't know if they're going to come back, right? I just don't know if they're going to make it through this.
Mm-hmm.
So aside from the stock, I know that's probably the biggest allocation we have. That's the biggest allocation we have, but bonds are a hugely important factor for us too. And if you remember, I do think the bond market generally is a great diversifier for assets, but this year it hasn't been. Right? And I would contend because of the inflation we saw in the chart with the previous charts, inflation was the bigger issue we had. That's the carnage in the inflation market is really causing carnage in the bond market. So the bonds have been extremely volatile. Bonds are down about 15% this year. The bond index on average. This is one of the worst years we've seen in bonds in the last 100 years. So it is truly an unprecedented time in the bond market. Again, Josh was mentioning how we have been concerned about inflation for a while now, so that's something new for some of our frequent guests. So our bond allocation has changed slightly over the past few years. And so what we've been doing for the last few years is, this is a few years ago, is that we got out of emerging markets and international bonds, right? We had a good swath of that in the bond portfolios. We've been out of that for a few years now, but we just didn't like the aspect of how the dollar played and maybe the potential strength of the dollar. Or the weakness in our case, the euro currency. And so we've been worried about that space for us. So we sold out of all of our international emerging market bond funds a few years back. Right before COVID, we didn't know COVID was coming, right? Right before COVID, we also sold out of our high yield bonds, right? Or what we call junk bonds and more speculative grade bonds. We're getting paid around 5 to 6% on those bonds, much more than what we're getting in safer bonds. But for the extra risk, we thought, back then, junk bonds would have been great. But when those yields started coming down to about 5 or 6, we thought we were getting paid enough for that risk. And we have since sold out of all those bonds right before COVID. And so I think that's one of the better trades we made. So now we've left with some higher quality issuance. The other thing that we avoided is long-term treasuries, right? We thought that with rates positioned where they were, with rates so low that they probably would go up. We didn't think they were up this much, but with rates going potentially up, we really avoided longer term bonds, right? Longer term treasuries, longer term government bonds. We didn't want to have that what we call duration risk in the portfolios, because we didn't think we're getting paid for it. So where have you put the money? That's why the next question, right?
Sure.
And you can see in your portfolio, we really put almost a lot of the dollars back in their short-term bonds. We have short-term government bonds, right, and short-term high-quality bonds, investment grade bonds in the portfolio. So everything, a lot of the bonds are short-term. They should be using two investment products for that. But we think that's probably a great area to hang out right now in the short term. Short-term bonds, these short-term treasuries are paying about 3.5 to 4%, and that's a pretty attractive alternative for many clients, especially out of cash.
I think again, the theme's almost the same as what we just talked about on the equity side, right? In this case, with the bonds, you have varying levels of risk, right? And if we're holding high yield bonds that are longer duration, they tend to hold more risk in a rising interest rate environment. Whereas if you're holding shorter term bonds that are higher quality, right? And short, in shorter duration, that's going to hold less risk in a rising interest rate environment, right? And so, again, I think this goes towards that high quality, right? And a bit more conservative, which is what the allocation ended up doing early on. So what about now? Right. So I think that
who cares about yesterday? It's
yeah,
now.
Yeah. Okay. So this is what's happened, right? So, but what what's going on moving forward? So I think that especially a lot of people that are watching right now, we may already be in a recession, right? We've got this, we've had 2 negative quarters of GDP, right? And and then I'm also hearing a lot of, well, we may be heading into a recession. So I guess the question is, are we in a recession? Do we think we're heading into a recession? And then is everything that we talked about still relevant? Is that the right strategy to be doing as if this is what the expectation would be moving forward?
Let's back up a little bit here and talk about this. First of all, I agree. This is a really popular question, and I agree. Our contention, especially if you read our market updates, is that we are probably likely in a recession already or going into one very shortly. But before we do that, let's step back and define what a recession is, because I think there's some confusion about what a recession is. In America here, we don't define a recession as 2 negative quarters of GDP. I think that's a really overly simplistic term that might be better for smaller economies. Like the U.S. is extremely the most complex economy out there. And so back about 70 years ago, the U.S. did really defer to a third-party nonpartisan association called NBER, or the National Bureau of Economic Research. And they were ordered to determine this. They're already tracking the business cycle, right? And whether or not we're expanding or recession or growing. And so we asked them to also keep track of not just the business cycle, but when a recession is. And so they've been referred to as actually, they're the kind of the nonpartisan arbiters of if we're not in a recession or not. And so there was just 2 quarters of negative GDP growth, probably not the best idea. So they wanted to see a sustained and prolonged downturn in some really 4 major categories. You think about consumer and business spending, personal income, like how much you're making, right? Income. How's the manufacturing economy doing? And employment, and the third factor, the fourth factor is employment. And if you look at almost all 4 of those categories, 3 out of the 4 categories are negative, right? And so the only thing that's actually doing well is unemployment, and that's the outlier here. And so I think it will be quite soon when we see unemployment tick up a little bit or employment situation get worse. I would think that the NBER would likely declare a recession relatively soon. I think because we're seeing that kind of pain. But regardless, the base case is that we agree with you. We think that the economy is probably already in recession or likely to head in anyone's very soon. So high inflation is really having impacts on consumer spending. We're seeing that. I mean, I said unemployment is really strong. We're just starting to see some of the manufacturing data come in now. I think the manufacturing has been weak for months now, but we're starting to see data now that's showing that manufacturing is pretty bad. And we talked about this a few months ago, and I think we're starting to see that now. And I think the data from manufacturing will continue to get worse. The next question is really what next, right? And so I think with manufacturing getting worse and rolling over, you're probably going to likely see an earnings recession too. I think companies are going to start to revise their numbers lower. We're kind of seeing that now in the last couple of weeks. They're saying, wow, things aren't as good, or things didn't improve like we would hope. Or we're going to do some cost cutting, do some layoffs, and I think we're really going to see earnings be front and center. I think right now, and especially now that this is kind of a rough week to do this too, right? Because this week is also the start of the earnings season. We had a bunch of banks reporting this week, and the later half this week, they're the first companies to start reporting, and so we're going to get a very good glimpse on how the earnings is going to turn out.
Right. I think you have a lot of bigger banks are reporting on Friday, right?
Yeah. Yeah. So the base case, we still think to hide in the market is the best. The best thing to do is still stick with high quality. I don't think it's right now it's the right time to be reaching for speculative investments or things for a turnaround too. I don't think the bottom is set in for the market, and I think that I think it's probably too soon to make any dramatic changes in portfolio positioning. Of course, the biggest question is that's our base case, and we talk about what if we're wrong, right? And we have kind of different positive and pessimistic views on it. The issue is, and I continue to harp on this again, Josh, is inflation, right? Will inflation come down as we expect it to, or will it remain transitory, as the Fed has said? Our base case is that inflation will start to ease out a little bit, not as dramatic as one would have hoped, but still come down slightly. We're starting to see some easing of the inflationary pressures. But what happens if we're wrong, right? Gas prices are going to start to come back up. They wasn't going straight down. It's starting to come back. What happens if gas prices get even higher right here? Sure. What happens about food prices, especially as we go into the holiday season? Look on the geopolitical events that we're going through right now. Let's set aside the stuff in Europe with Russia and Ukraine. In the UK, right? We still have tremendous issues with the Middle East, right? Not just Saudi Arabia, but look what's happening in Iran right now on a social front. And I have to mention China and Taiwan, right? And especially with what Biden did last week, and that is escalating very, very quickly. And so geopolitical events are a big part of today's environment. And then the economy, right? We don't really anticipate the economy to dramatically slow down or heat up, but what happens if we're wrong? What happens in the economy? I think there's a good risk of both sides that the economy can slow down more than we think or heat up faster than we think. So that's kind of thing that we're looking out for.
So I have to ask, because I know this is what a lot of folks are asking, right? If we think we're going to recession next year, right? And that's our base case. We think we're going into recession next year. There's still potential for inflation to continue to be a problem. We could continue to see geopolitical issues, right? These are things we're pointing to as being risks, right? And so with all these kinds of economic risks, why don't we just make the move now? Why don't we sell? Why don't we get more conservative? Can't I just go into cash? And then when everything settles down and everything goes back up and the economy's fine again, then I get back in at that point in time.
Yeah, that would feel like a great strategy, but does it actually work, right? Would it feel like to wait for the all clear signal and venture back in the markets? Well, Steve did some great research on this too. So
as Josh mentioned, those things could definitely happen. But as Andrew mentioned earlier with the unemployment data, it's very possible for data to get worse before things start to turn around. What we're looking at here is equity market performance compared to the economy. The economy here is GDP, which is a gross domestic product, and that's just a measure of productivity. If you look at the left-hand chart for 2020, you can see that right after April, during all the COVID lockdowns, there's a sharp decline in GDP. And, this makes sense because a lot of services and manufacturing regions were closed down. If you think about your everyday retailer and your manufacturing plants, clearly America wasn't productive. And as a result, GDP did bottom out, is what you could see there in July. But the big thing to pay attention to here is that the S&P actually bottomed about 2 to 4 months in advance before GDP. And why is this? It's really because GDP, again, is lagging data. And, if you're waiting for data to improve, you're definitely going to miss a recovery. Just take a look at where the high point of GDP is on that left chart and look at that sharp move in the S&P. It really didn't recover until February of 2021. So again, the big point here is that you shouldn't wait for data to improve.
Yeah, I mean, look at this chart, Jose. I mean, you look this is the left one here that my icon on. During COVID, if you would have waited for the GDP to get back to where it was pre-COVID, you would have missed out on about 30 to 50% of the market's returns from the bottom here. And so that's a dramatic give up if you just waited for things for the all clear sign in the economy.
I mean, I have to say, and I would encourage everybody, take the emotional step back, put yourself back into the shoes of being in that period of time in March of 2020, right? And so the market came down. I know people who said, hey, I can't handle this. They chose to get out, right? And then the market recovered, and it recovered relatively rapidly, right? However, at that point in time, especially for those that had chosen to get out ahead of time, when you're going through it, you turn the TV on. If you guys remember from that time period, April, May, June, July, really through the remainder of that year, most of those talking heads on TV, people you respect, were calling for and saying, hey, there's a double dip that's going to come. Everyone's at home. Nobody is working. Lots of the conversations I was having is, hey, the economy is doing terrible. Nobody's working. Like nobody has a job. Why is the stock market running and going up, right? And for those folks that had sold prior, right, and maybe they got out 2 weeks before reaching the bottom and they saved themselves a little bit on the downside. But when do you get back in? When do you determine that things have recovered, right? Because there's always cause for some bad news that's out there. And a lot of folks didn't get back in until the following year, 2021. Missing out on all that upside and all those, not just the recovery, but the gains that went along with it as well.
Yeah, we clearly, the recession question is a big issue, right? Because I think that it's we haven't had one for a while now. I think we're clearly going into one. We're seeing that sign across the board, but we really can't wait for Edinburgh or the U.S. government to declare a recession, right? It's almost a moot point by the time they do declare a recession. Our job really is to guide our clients and our client portfolios through the recession. We can't guide our portfolio around a recession, right? Where that's most possible. We have to guide it through it and go through the eye of the storm.
Yeah, I think that because it's always lagging information, we could technically be out of a recession by the time it's being declared that we were ever in one.
Completely.
Right.
That's very highly likely.
Yeah. Now, I think that speaks a lot on the equity side of things, but I mean, how about bonds? We've been talking about inflation. We've been talking about interest rates rising. We're watching the Fed nonstop. We know interest rates are expected to continue to go up, right? So, I mean, shouldn't I just be selling my bonds now? Couldn't I say, hey, I'm going to sell my bonds now, and then I'll get back into bonds and I'll buy them once we've gotten through all of this. And maybe I'm even going to get some higher interest rates at that point in time.
Yeah, I think this is one of the most important questions that we're talking about right now. Because as I said a little while ago, the bond market is defined as the Bloomberg average, right? Just a lot of the bonds across the United States. That's down about 15%. Like, this is one of the worst years you've had in the last, not 10 or 20 years, but last 100 years. We haven't seen some of this around the First World War. This is a really unprecedented time. And for the fact that bonds are down with stocks is highly unusual. That diversification really hasn't helped out too much this year. But I do think that diversification will help out going forward. I do think that a lot of bonds, I'm more excited about bonds today than I was last 2 years, right? So like there's opportunities in there. But I think the idea of getting out of bonds is a rough one for me right now, especially because I think that the Fed is clearly explicitly saying, inexplicitly saying they're clearly pushing the U.S. economy into a recession, public economy into growth. They have to cool down inflation at the price of, and they said this is not my words, at the price of unemployment, at the price of housing, and the price of the economy. And so you will likely see recession, a Fed created recession just to slow inflation. And so I don't know if I would be really comfortable selling out of all my bonds, waiting and sitting in cash, waiting and being all equities in cash and waiting for the recession, right? And I don't know that that's the best move for portfolios. So we do think that at some point, even if the Fed doesn't cut rates right away, I do think that the Fed will probably slow down and what the course of action is. And Kenny's going to talk about that.
Thanks, Ben. Yeah, so to build on top of that point, let's take a look at this chart here. So what we see here are the interest rate expectations of the 12 Federal Reserve members from where we were ending in 2021 to where they expect us to be at the end of this year and at the end of next year. So this is a great chart for us to understand because it shows us what the Fed might be thinking as well as feeling. And it shows us how the Fed members think they should be approaching inflation. So what we're seeing here on the left, portion of this chart, is where the Fed had interest rates at the end of last year, basically 0%. What we're seeing now is this green line has increased. And the move that we saw, like Ben mentioned earlier, was a 300 basis point move, or roughly 3%. And when we look beyond this green line is a peak. And at the peak of this curve, we actually see it flattening out, represented between that 4.25 and 4.75% move. So the two sides of this coin is that the Fed actually feels that they need to keep rates elevated for the remainder of this year, but the flatter line between 2020 and 2023 represents that they're actually going to be slowing down. The other side of this coin and what it signals is that we should actually be watching the market, because the minute the markets get a hint that the Federal Reserve is going to be lightening up, aka taking a slower and flatter path, markets could already be moving.
I think that's incredibly insightful. I mean, I think that there's two things that I'm seeing here that I'm curious about. So one is, I mean, we look at the rate of increase this year, and that's been incredibly rapid. Possibly getting to about 4.25 by end of this year, beginning of next year. But then only increasing by about 50 basis points, 0.5% throughout all of next year. But Kenny, my question is this locked in? Is this what's going to happen? Like, this is what we can expect is going to happen with interest rates next year?
Thanks, Josh. That's actually a really great question. So like I said, we're sitting at 3.25%, but that's what already happened. That's where we are now. The red is an expectation of what might happen. None of that has happened yet. And let me remind you, Josh, at the end of last year in 2021, this same chart was showing us that the Fed was thinking that they didn't need to raise rates past 2%. And like I mentioned and Ben mentioned, we're already at 3.25. We did 300 basis points in 1 year. So, but now they're telling us we should at least expect 4. So no, I want to say no, nothing is locked in.
I can't tell you. I mean, I think this is one of the most important charts in the short decade that we have, and I really want to reiterate what Kenny was talking about. A year ago this month, the Fed was thinking that they would only have to raise interest rates by 0.25% for this year, for 2022. They have raised interest rates by 300 basis points, 3.0% so far this year, and it's possibly another 4 percentage point before the end. That is not a Powell pivot. That is a Powell U-turn. Okay, and so that huge change in their stance and how dramatic the Fed has changed has really led to issues across the board in almost all what we call cross asset classes or cross numerous asset classes. It's not just bonds, the stocks and commodities and currencies. That's caused a lot of pain in almost all assets have fallen. The big issue that is applied to this is that this dramatic Powell U-turn has really caused bond volatility. We talk about a lot of people talk about stock volatility with the VIX. Bond volatility is eventually important because bonds are usually the quiet brother, right? They don't move around prices that much, but this year they have, and that bond volatility has caused some dramatic pain. I mean, I think the best example is the mortgage market, right? The mortgage market has changed dramatically. About a year ago or a year and a half ago, you could have probably got a mortgage at around a 30-year fixed, right? Conforming at what, 3-ish? Yeah, 3-ish, 2.5, 2.75 to 3%, right?
Yeah.
And then remember the Fed raised rates by 30 basis points. So you think, okay, my mortgage should be about 2.5 to 5.5%, right? That's what, mortgage rates are close to 7% right now. So even though the 10-year treasury, mortgage rates have moved up, or bonds have moved up about 300 basis points, mortgage rates have moved up 400, 500 basis points, right? It's a much more volatile move in the things that are affected by the Fed funds. And that's been really a huge cause in the mortgage market. So that bond volatility is tremendous. I think with this flattening of the future of future rates here, if this does pose true, if we do stay at around another 25-50 basis point increase next year, I can still see interest rates going higher next year. But if the bond volatility drops, I think that could be a great thing for bonds. I think that could pose a lot of pricing. That could be a lot of good things for pricing of bonds and how the bond market reacts. I think the bond market have a much better year next year, even in the face of rising interest rates, if just the bond volatility comes down a little bit. But that hasn't happened yet. So what we're looking at now, right? And so when we talk about opportunities, I think you do have to look at some opportunities in bonds. As I just mentioned, we're still extremely short term and extremely high quality in our bond portfolio. But here there's some we are looking at not changing our allocation there, right? We're looking at think about something called credit, right? Looking at some things that are not U.S. government bonds, not as safe as U.S. government bonds. Right now, if you look at investing in some investment grade bonds from high quality companies like Pepsi, Johnson & Johnson, right? Household names. Sure. You can get about a 5.5 to 6% yield, what we call yield to worst, right? And those are what they're kind of yielding right now. That's pretty attractive. 5.5 to 6% in high quality bonds, right? Treasuries are now paying 4. High quality corporate bonds are paying 5.5 to 6. If you want to even step out in the further the risk scale, maybe go for speculative grade bonds like a high yield bond, they're yielding north of 8% right now. And so those are some numbers. I think the high yield may be a little bit too tough for us right now going into a potential recession. But I think we have to look at other asset classes besides short-term, high quality treasuries for portfolios. If you want to hit those retirement goals, you want to hit those asset allocation goals, 5.5%, 6.5% on some high quality bonds is very attractive to us right now.
So I mean, so there's opportunity that exists out there, right? And this sounds, I mean, it sounds fantastic. I'm happy to get, you know, an 8%
Yeah.
return on my bonds is fantastic. But however, I think what's probably on a lot of our listeners' mind is, look, I've lost 10, 15, 20% in my portfolio this year. How long is it going to take to get that back?
Yeah.
I mean, you know, when am I gonna be able to recover and get that back, and at least get back to a break even?
Yeah, that's a tough question. I mean, this is the most important question. The most important question, the most popular question we've gotten is how can we make our money back? It's tough because I do think that the market is in still an adjustment period, and I think that if we look at the past, we might not be stopped here just down 25. I think we could go a little bit lower before things get better, especially in the wake of some of the economic news we're talking about. But the issue is that what can we do to what can you do to prevent that, right? And so some of the things we learned about how to make effective money is, number one is just stick to the plan, right?
Yeah.
Hopefully you have a good plan with us, because we really preach that here. But it's not just, you know, there's two aspects of the plan. Like we have an investment plan for you, what we're talking about right now,
Sure.
and also your financial plan, or for your financial plan, right? Are you trying to, what's your goal? Are you trying to retire? Are you trying to be in college? What are your goals? And when we do a comprehensive financial planning analysis with Josh and Chris and Landon and Ronna and Harmon and Megan and Cole, their analysis doesn't just count good years, right? It doesn't say that the market is going to do 6% indefinite for forever. Our analysis comprises of recessions, good years, bad years, declines like this, you know, changes in the bond market, right? We run these analyses that could incorporate many different cycles or possibilities, and a lot of this, most of this analysis does incorporate drawdowns like we're seeing this year, and this is still a relatively normal year. And so stick to the plan, get a financial plan, make sure that that your plan is robust and can withstand years like we're seeing this year. Number two, stick to the plan. Stick to the investment plan, right? Don't make any sudden dramatic changes. I think that's where things can go off the radar, right? And we use the analogy of you're driving in the fast lane, and if you want to slow down, just to go from the fast lane to the right lane, right? You don't want to just crank your wheel to the right. And that's how you get into an accident. If you want to slow down, that's fine, but do it slowly and do it methodical. Don't make any sudden or dramatic changes in your allocation. Don't go from 100% stocks to cash. Don't try to go in and out of the market. Don't try to time the market in and out. Try to sell when it's high and buy when it's low, and do that, because that's really difficult to do, right? Some clients, you know, are asking, should I just do this buy and hold thing, or should I start day trading now? And that was another question we got. Should I start day trading now? If you have experience in day trading, maybe, but if you're going to start day trading now at when the market is down 25%, I think that's a really dangerous disaster, right? Do you want to try to become a firefighter when your house is on fire? No, you should probably train to be a firefighter before your house gets on fire, right? And so I think that's really, really dangerous. Don't try new strategies that you're not used to, that you haven't experienced.
This is a good time to state that for us, our methodology, we are long-term investors. We're not day traders. And oftentimes, especially even with things like trend following or technically traded strategies, that tends to be more of a anytime we're selling, right? Because the market's down, we're trying to protect ourselves on the downside, right? So we're trying to find a conservative, a risk averse strategy. I want safety. I'm seeking safety. Okay. Anytime I'm moving from more high risk to more conservative, more safety, right? More low risk. There's a cost to that, right? I'm giving something up. And oftentimes what happens is we sell when things are coming down in order to get conservative. But then when we get back in most cases, we've already missed the most immediate largest gains. We've missed that upside. And over a long period of time, that type of strategy, short term can work out. But over the long term, historically, you do not expect to outperform the market in that type of a strategy or that type of methodology. You're giving up some upside in requesting and asking for that downside protection and safety.
So but that's a great point, Josh. So let's actually put some math in, right?
Yeah.
Because we did get this question from a client.
Sure.
Right. So the client is, say, 100% equities. He's down about 25% like the SP is right this year, right?
Sure.
20 to 25%. And he's asking, well, should I sell everything now and go put in these 4% US treasuries, which is 4% in the U.S. Treasury is attractive, right? But is it attractive relative to what he made up in stocks, or what he lost in stocks? So if he did do that, just do the math, right? How long will it? If you're down 25, sell everything and put it into 4% U.S. Treasury. How long will it take you to make back your money? 6 years, right? And is that something? Yeah. Actually 6.5 years. But is that kind of gonna hit your goals? And that's kind of for them to answer. And for us, I don't know if that's the right answer. I mean, I know they wouldn't do it. But let's look back at history, right? Let's look back at history and see if that worked out.
Yeah, I think this brings us to back to our question begin with, which is how long should I expect it to come back? If I don't do that, if I don't go put it in the 4% bond, how long should I expect if I stay invested?
Yeah, and Jose, I think Jose did some great work on this for us.
And on the point of making your money back and really sticking to your financial plan, what we have here is the returns of the S&P 500. Whenever it had a drawdown of more than 25%, this data is as of 1950. And in the blue bars, that is the max decline during that period. So starting from the left-hand side in the early 60s, we had the flash crash, which came after a period of high growth. In the early 70s, the oil embargo. In the early 80s, there was high inflation and tight monetary policy. And in the late 80s, there was a Black Monday. Obviously, we had the dot-com bubble of early 2000s and the global financial crisis. Two big things to note here is, these market cycles, these downturns, they don't last forever. And two, we don't see the current environment like what we saw in the GFC, the global financial crisis, where markets dropped by more than 50%. So let's just set apart the 10-year performance in orange, and let's just look at the short end, the 1 to 3 year returns. And what this shows is really that regardless of your time horizon, even though the decline might be tough to bear with, if you sit through and follow your financial plan, the takeaway here is that within 1 to 3 years, a lot of those investors who stayed put really recovered most of those losses.
It says that, I could expect about 1 to 3 years for recovery. Question, Jose, can that happen faster than 1 to 3 years?
Yeah, of course. I mean, just look at the decline from 2020. The decline during that time was about 33%, and the 1 year later return was over 50%. It was actually 56%. So definitely.
And I think the reverse side of that coin is it can also take longer as well, right?
Exactly.
Right. So if we have to pick something, we're going to pick something. This is, I think Ben's kind of talked about it a bit, but I think this is a fairly normal recession that we're going through. It doesn't look like it's a great financial crisis that we're falling into. Things look very different today than they did in an 08 type scenario. So I think something in the 1 to 3 year range is a very reasonable expectation. Anything can happen, right? But this is what history shows.
Yep. Also, I mean, let's kind of wrap this up here with the Q&A. I think we have a lot of good questions.
Yeah, absolutely.
But I mean, some of the things I want to emphasize here that we do think a recession is coming. I don't think that is a guess anymore. I think a recession is coming, if not, we're already in one. We don't think we're in a crisis right now. We don't think this is anything like the tech wreck or even the great financial crisis we saw about 12 years ago right now. Banks are still running. We haven't seen any huge blowout and spreads, or we haven't had any credit events. No huge bankruptcies, no huge catastrophes like we saw with the banking sector and the insurance sector 12 years ago. So I think right now it seems like a really much a liquidity-driven recession. I do think that we are in the midst of this, and I think it could get worse. And I think that likely we're just starting to see the spat of economic data show up. And specifically, we're talking about manufacturing. You're really starting to see weakness in manufacturing, and that data is going to continue to get worse. I also think that the unemployment data could also get worse too, shortly after that. I think most of this data is priced in. I do think a lot of this data is already priced into the economy and into the markets. That's why we're not in a recession right now, but the market is already down 25%, right? Where the market is clearly front loading and anticipating what's been going on. So I think a lot of the data, who knows how much of the data is priced in? We'll know more as we come into earnings season in the next few weeks, but I think a lot of the data is already priced in. So that's kind of our base case scenario.
Well, okay, so I think that's a great summary for us to kind of where we're at, what we think, moving forward. I think that just because we expect negative data moving forward doesn't mean that the market hasn't priced in the negative data already, or mean that we know exactly how the market's going to react to that negative data as it's coming out. All right, but what we can do is we can create a good plan, we can stick to the plan, and we can own good quality assets inside of the portfolio along the way. Now, this is a question directly from our audience. Do you think that the Dow Jones, right, could go down to 15,000?
So let's put this in perspective right now. What is that? What is it?
Yeah.
The Dow Jones is currently at about 30,000. We don't really track Dow Jones. Most institutional investors do use the S&P 500, but it's the same thing, right? And so for the Dow to go down to about 15,000 would imply that the market would fall at about half from here, down about 50% from here, and meaning the total loss would be about 75% from the highs. No, I don't think that's gonna. I think that's a very low probability bet. That's not something that we're counting on. We're clearly not that. We don't think that because number one, we're not in a crisis like I mentioned.
Right.
And that could throw it off too.
Right.
The other issue is that we're still seeing relative strength in corporate America, right? And so a couple of things here is that companies are still doing relatively well, right? When you look at large U.S. companies, not all companies, but large U.S. companies are real wheelhouse. They're making a ton of money. They are sitting on what we call fat profit margins. And so this is a chart of the profit margins for the S&P 500. And yes, I know inflation is starting to eat away at this, right? Inflation is at a 40-year high, but I would just be dismissive. I didn't mention that profit margins are at a 50-year high. So I know inflation is high, but profit margins have been higher, and we're seeing that at a tremendous level. So I think companies can really, or not really, but I think they're better poised to withstand some of the shocks we're seeing to the system now more than almost any other time in history, right? They can withstand maybe some higher input costs, higher commodity costs, higher shipping costs, higher wages for employees. So I think that corporations are really poised to deal with this. And as I mentioned, lots been priced in, right? And this is a chart of the S&P 500's valuation. One measure of valuation, at least, or what we call the price to earnings ratio, how much you're paying for $1 worth of profits for the S&P 500. And historically, that sits at around 16 to 18 times right now, we come all the way back down. We've been as high as in the mid to high 20s. We got as high as 30 during the COVID spike. Right now, we're down to about 17 times, 16 times forward earnings. So because valuations aren't completely out of line, they're more within historical norms. They can get cheaper. They're more historical norms. We don't see the S&P falling by half. I do think that when you look back at some of the comments that people like Mike Wilson from Morgan Stanley, Jamie Dimon from JP Morgan made recently, when they say that the market could fall by another 10-15%, that's where they're basing this. I think a lot is based on this number right here, that if the valuation on the market go back down to maybe cheaper levels, 15-14 times, I think that's what is driving a potential decline in the market. And that's why they're getting like another 10-15% decline in the market.
I mean, on average, what would you say would be a normal PE ratio for the market?
Yeah, when you look at that, it's close to about 16 to 18 times. That's a normal historical range for the last 10, 15, 20 years.
So we really are kind of right in that pocket.
Yeah.
Maybe on the upper end of that pocket, but we're kind of right in.
Yeah, we're right. We're not super cheap, but we're definitely not near the piece we saw in the last few years.
Okay, what about, I mean, this year, technology sector has it's been brutal, right? Technology sector has really gotten beat up pretty heavily this year. And yet energy has been doing fantastic. Right, but if we went back 2 years to 2020, energy was getting wrecked, right? And tech was soaring, right? They've almost flipped places right now. So, looking at that, I mean, is it, do you have any specific outlook on the tech sector right now? I mean, is it, hey, we should get out of this? Could it possibly come back? I mean, what are our thoughts in that sector?
Yeah, I think the tech sector is a little tough because it's so diverse with so many great businesses, right? And this is still honestly the core of much of America's economy, right? Where you talk about the large companies like the Apples, the Amazons, the Googles, Facebook, Meta, all the big technology companies that are in indices. I still think that they're doing tremendously well, and they're really the core of the economy. I think we depend on use so many of the products every day. But it's been painful, right? We look at the issue like the semiconductor industry, right? It's been so sensitive to the demand of the economy, and the recent inventory buildup in some of these semiconductor companies has been a huge change in their growth, right? And a lot of these companies still are tremendously important to the economy. There's still a huge demand for semiconductors. Everything we use, whether it's simple chips for calculators and mice like this, or to complex chips like we're using computers and this camera here, or definitely in AI cars and self-driverless cars. There's I think they're a huge demand. I think that's still a very strong place to be, especially if you want to look at American production of these semiconductors, right? And I think in this, unfortunately, in this geopolitical world that we're living in, I think you have to look back at looking at American production for these hugely vital components of the economy. But right now they're very cyclical. Right now, semiconductors are extremely cyclical, and they're getting hit by the business cycle. So on top of that, some of the geopolitical news, that policies coming out of Washington D.C., they've been tough holds, man.
Well, thank you. Okay, another question that came from our survey responses that were out there. And I was actually really surprised because there were multiple questions about this. So people are thinking about it, maybe not from the standpoint that a lot of folks will initially think, but ESG, which is environmental, social, and government, investing in that ESG sector or segment. What are your thoughts on that? Does Apriem do ESG investing? Do we not do ESG investing? I mean, what do we think about that, and where do we stand?
Yeah, ESG investing. Wow, that's a kind of interesting one, right? That's ESG investing has been around for a while now. Arguably 20-25 years now, right? They were just getting started when I first got into the business and kind of went away. And it's the whole concept of investing your dollars to align with your beliefs. And that's why I don't know what your beliefs are, but it can be environmental, the environment, it can be social issues or governance issues. And that's what ESG stands for. The problem is that it's a very difficult space to be in, number one. And number two, everyone's views are very different. And we avoided ESG investing at Apriem. When we thought about 20 years ago, we thought it was not a good solution for us. And we continue to avoid ESG investing today. It's just not because we don't like it, but the two biggest issues is that, number one, it's very hard to define what's a good ESG company and what's a bad ESG company. And so there's many companies that do this, right? Like BlackRock. And some ESG indexes will include some companies and not include some companies. Yeah, we've opted to stay out of that. I also think, especially back 20 years ago, I do think that ESG was really created from a marketing standpoint, from just really to charge higher fees, right? And I think fees have come down, but I think ESG is just a really expensive way to get exposure to the market still at this point. So I think it's one of those gimmicks that Wall Street's trying to sell investors to make more money. I do think if that is your cause, though, if you want to be invested in ESG companies or non-ESG companies, I don't know if this is the best place. I think a better way to really deploy capital, if that was your goal, is to take some of these like where you buy a stock and they donate the stock, right? And some of these newer companies, private equity backed companies, venture capital backed companies, I think that might be a better place to affect ESG change if that's really what your goals are.
So I just want to make a point here, because as you were talking about it, was I was thinking this in my head, and it's that it's not like there's a screening tool for good, right? Like that's a very subjective terminology,
exactly.
Right? And then you go out and that means you have to do additional research and dig into these companies to figure out all the ins and outs and what you would consider to be, good versus bad, right? And it could be political donations, right? Who are they, who do they back politically, right? But all of that on a per company basis, that's not an easy click of the button filter. That's time, effort, research, which again is all cost. Right. And so it becomes very expensive to go down this route. And it can affect those long-term returns for the portfolio in general.
Yeah.
Right. Okay, so let's talk about another asset class here. Okay, housing. Let's think, we've talked about interest rates, mortgage rates have skyrocketed this year. What's our thought on housing and this environment that we're in? Is it still a good investment?
I think this, and I'm trying to weave in one of our client questions here, where they're asking about inflation and stagflation, what the difference is, right? Housing, I think, is still a great investment. I think it has some, obviously some issues that we're seeing right now with high mortgage rates, right? But I think buying a new home is really rough right now for first-time home buyers, especially. If you have to get a mortgage, especially really tough right now. But if you're in your home, I think it's a great investment still. And I think the reason why I think housing is still a great investment is because I think we're in a relatively moderate, higher than normal inflationary period. I think that's really good for housing, right? And what can be bad for housing is the period of stagflation. And one of the questions we got is what's the difference between inflation versus stagflation? And the inflation is just what we're going through now, right? It's relatively decent economy, but high prices going up. Everything costs more. You wake up, go to coffee, you go to the grocery store, it costs more. But stagflation, the biggest difference between stagflation is, and we saw this in the 70s, it's not just high inflation with low growth, but it's high inflation with low growth and high unemployment. And so that people forget that high unemployment factor in the stagflation. So that's the big delta. And so right now we're not in a period of stagflation given the high employment rate we're having right now, low unemployment we're having right now, relatively modest, decent growth, but we're having, but the high inflation is one of them. So I think we're in a high inflationary period, but not really a stagflationary period. And in that situation, I think housing is still a really good investment. If you're not a first-time home buyer. The reason why I say it because employment is still relatively strong. The economy is still relatively strong, so that's a good backdrop for housing. Also, when you look at housing, about 65, especially post great financial crisis, the home ownership rate in America is about, call it 64-65%, relatively consistent. And that's been a huge, that's a great number to stay at, right? You don't want to get too high or too low. But really, since the great financial crisis, one of the big changes that we've had to the mortgage market specifically is gravitating away from ARMs to fixed, right? We are the typical American does not do a variable rate loan. They don't do an adjustable rate mortgage or an ARM. 95% of American mortgages are fixed rate mortgages, generally 15 to 30-year fixed rate mortgages. And that's a huge change. So most mortgage holders, something about 70% of mortgage holders right now, if you bought a home before now, they have a fixed rate mortgage for around 3%. Right. And so I think that's going to cause a lot of stability in the mortgage and housing market, right? It's less likely you're going to default if you have a great mortgage and you have a job and the economy is doing okay. If you're locked into 3%, I think that really poses a nice backdrop for housing. And then we can talk about those other backdrops here. I think that there's a chronic undersupply of entry-level homes here in America. We haven't built enough entry-level homes in arguably 15 years, right? And so I think that demand dynamic is sets up very well for housing. But I think it'd be a rough few months, especially with the mortgage market.
Thank you. Okay, so here's one that comes up here and there, not as much as some of these last questions that we've come up that we've talked about, but gold, silver, some of these commodities, so based on what we're experiencing right now, I think oftentimes the thesis is, oh, we have high inflation, I should be buying gold and silver because that does well during high inflationary environments. Is that what the data shows? I mean, what are your thoughts on that?
Yeah, I mean, we didn't get a lot of questions on this gold and silver question this year, but we get it in the past, right?
Yeah.
So I think the gold and silver situation is a really interesting one. And I start off with what should be. I do. Everyone's kind of different on this topic, but I do start with asking clients when they ask me about what is their thesis on it. And if you're investing in gold and silver for inflation, I think that's a really poor thesis. And the long term, short term, I've seen no correlation with inflation and gold, right? Over the last 50 years, since the 80s with Volcker, no correlation. And even this year, right? Inflation is up high single digits, right? It's the highest we've seen in decades. Gold's down. Gold's down 10% this year. So it's very tough for me to see the gold and inflation thing as gold is a good trade because due to inflation. I think the reason for gold and silver is more really for global crises, right? Global instability. Periods of war, right? And so great financial crises. And I think that's a better reason. And so again, when you look back at the great financial crisis, there was a lot of concerns about what was going to happen with banks and whether they get money at the ATM. Is Washington Mutual going to open up tomorrow? They didn't open up. And so what's going to happen with Lehman Brothers? They never recovered, right? And so when during those situations, I think that's when I would like to have precious metals in my and I do. I personally have precious metal, various precious metals in my home safe for my family. but I have them in divisible amounts, right? And so I'm not going to have a gold bar in my safe and chip away at it when I need to buy groceries or fill up my car with gas, right? I have smaller amounts that are divisible, so I can barter things if things really get out of control and things really get out of hand. But that's almost a hedge against global crises, not really inflation.
Okay, those are really good. We're about an hour and 20 minutes over, well, not over, about 20 minutes over the hour at this point in time. So it's about 2:50 at the moment. May we do a few last questions and then we'll finish it up?
Yeah.
One that I saw that I think, it's an easy one to answer, but I think a lot of people should know. And the question is, how do you decide if an investment should be sold at a loss versus keep an investment at lower prices and dollar average?
Yeah, this is a great question for one of our favorite clients. It's actually quite simple. We tend not to just look at just the cost basis or the loss that's in the company, right? Because that is assuming that we got the buy rate and then we get the sell rate too. We do a weekly valuation of these companies. We are constantly looking at these companies, any updates to their businesses, their cash flows, their profits, all those fundamental stuff that you know and love. But we look at that week, right? And we update them constantly. And so we'll update them constantly. Has anything changed for them, right? Are they going through some major issue with their products or their supply lines, or just they have a bad product? Is the direction changed? And so generally speaking, when we look at a company, we look at it on a weekly basis to see whether that's still a good investment for current clients and for new clients coming in. And so we look at really the business prospects, all the good stuff like fundamentals, balance sheet, revenues, profitability, cash flow is how we determine whether or not an investment is good to have and get a hold on to or add to.
So I think that there was another question. I'm going to kind of rephrase it because this rolls off of everything you were just saying there.
Mhm.
But based on all that data that you look at, right, and all those details, right, and you have this watch list. This year, have you been removing or taking any companies away off of that list because of things that we've been experiencing right now to make them to where they don't really qualify or meet that criteria anymore?
Oh yeah, we have a pretty long watch list of names that we're looking for and names that we're currently buying right now. But yeah, we also look at these names and we've taken a lot of these companies off our watch list. When something does take the trading team, when it takes to agree where something we should look at, we'll do an in-depth analysis of these companies. Is this still is all the numbers adding up? Is there some one-time events that we can't expect to reoccur going in the future? What's the business prospects? So there has been a lot of companies that we looked at that just really crossed off the list that we thought, man, they're just having what I call a 10-point year, right? Like maybe 2020 or 2021 was a really good year, and it's really masking 9 other bad years, something like that. And so that can happen. And so we really try to avoid those names. A lot of companies do. I don't say a lot. Some companies do some financial engineering that we have to count for, and we have to roll those out too. And so being really selective to what we own, especially at this stage of the cycle, right? And we're like this all the time. Whereas we're passionate and really diligent about all the companies we hold and do a tremendous amount of due diligence on the capital we're deploying for clients. But it's really more important now, right? Especially as clearly changing, we're clearly entering a different part of the economic cycle. It's really important to pay attention to those details.
So I think this is a good time to kind of talk about market's been down, right? We think about that watch list, and you mentioned lights up green, right? It's hey, this is something that it might be triggering a buy. This could be a good time to buy this, right? There's a lot of green on that list at the moment, right?
There's a lot of green on that list, Josh, but there tends to be a lot of correlation on the list, right? And so I think that's what you need to be careful about is that, or the work that we are careful about is that when sectors, this is kind of back to your sector question, some sectors do trade in tandem, right? And so
I know exactly what I was thinking.
So what started turning green was early this year was a lot of energy companies, right? And so when we look at those, we're trying to find the best energy company for clients and not just invest in all of them. So we're trying to eliminate overlap in many cases, not just load up on 10 different energy companies or 10 different semiconductor companies, right? And so there's that question, we try to find the best breeder in those names.
Yeah, I think it's a great point, right? Because if we have 10 energy companies, they're all heavily discounted, they're all available to buy. Are we buying all of them? Are we really kind of going through and going, okay, these are all represent really good opportunity right now. Which one is the one that we want to go, and bet on and move forward with?
look at some of the questions here. I think this is a good one here.
Okay.
I'm
Go for it.
just gonna read it off here and answer. Why does the Fed appear to make Fed rate decisions based on lagging indicators as opposed to leading indicators?
That's a great question.
That's a good question.
Yeah.
I don't know. I'm not on the Fed. But I think, remember, I think it's clearly the data that they have, right? We can argue all day long, Josh, of the CPI, the primary gauge for inflation, PCE, the Fed's gauge for inflation is a good indicator. We can argue about whether or not is GDP an accurate way to gauge the strength of the U.S. economy. They're not perfect. Right, they're clearly not perfect, but it's the best we have, and it's what the best of the brightest have. Because I think there's some certainty in that it has passed, and unfortunately, it is very much lagging. Right, when we look back at just a simple GDP number that we have. Right, I don't know if you know, but we the third quarter's ended, so we're now into the fourth quarter, and so we're going to get GDP estimates this month. We're going to get another GDP estimate for the third quarter in November. And we get the final reading of GDP in December, right? And so that's almost a 3-month lag, like a 2.5 month lag, and I think that's very tough. And so because it's really complicated to compile how the economy is doing, it takes months and months of a lot of research to compile it. And so that the fact that it's lagging is difficult, but that's really the clearest view that the Fed has, and looking at leading indicators like we tend to do is a great predictor of many things, but not the best predictor, right? There's still a lot of uncertainty in leading indicators and a wide range of outcomes. And so I think that's why the Fed is tend to use more lagging indicators than leading indicators for the rate decision. But it's very interesting. And I think that does. I'm not defending the Fed, but I think that does lead to why it's very tough for the Fed to correctly navigate some of these situations. I mean, they do tend, I think, to this client's question, they do tend to overshoot or undershoot in almost every instance, right? They tend to overcorrect. They probably will overcorrect and raise interest rates too much, and then when the economy just slow down, then that's the reverse course.
Perfect. Well, it is 2:56. Unless you have one last question you really badly want to answer, I would say that the rest that's here, we'll have to follow up with you afterwards to see if we can get some answers directly out to you folks. And we're going to go ahead and kind of close it out now. So first, thank you to Ben and the entire Apriem Investment Committee. Thanks, guys, for joining us and helping to provide some insight on what's going on in the market now, what we're doing, what we're seeing moving forward. Now, thank you all for attending. You will have the opportunity to complete the survey at the end. I would like to encourage everyone to please do that. We do continue to read those surveys, take that information into consideration. We're trying to bring new content, change things up. You may notice that we're using a new webinar platform today, which is Zoom. We would love to hear some comments on whether or not you enjoyed it. And then our next and last educational event of the year will be the last Wednesday of November. And that's really going to be focused on estate planning. So we would love to invite everybody to join us there. You will get an email that will come out in the next week or so with invitation when registration goes live on the website. With that, thank you all again. Have a great rest of your day and
join us. Yeah, call us with any questions. We do have a lot of questions still pending. We're going to try to answer all your questions either directly via email, or I'll just give you a call myself, or have a team member give you a call. But please schedule reviews with us, right? With your call your wealth manager, get us reviewed. Come into the office, we're open.
Yep.
We do a Zoom if you want, but come into the office, we're always here. And let us look at any questions. We're doing things for you, and so I don't want to have any questions unanswered for you all.
Yeah, when you fill out the survey, there's an option to select if you want to do a review meeting, and then our team will reach out to schedule a good date and time for that. Okay.
Thanks, everyone.
Bye, everyone.